Welcome back to the Make It Count podcast.
I'm Marcus Mire, founder of Mire Group CPAs and the Total Control Accounting System.
And I'm Tyler Warner, small business owner with a lot of accounting questions.
All right, Tyler, today we're talking your favorite topic at cocktail parties.
A lot of people's favorite topic.
Yeah, of course. Cocktail parties and at the beach, which is the S Corp. So today we just want to kind of get into, we're going to get to a high level discussion of S Corps and try to give people some high level concepts about what they are, but also want to kind of dispel some of the myths that are kind of going around. You and I were talking before the episode about this is like literally when I say it out loud, it sounds funny, but like people getting their advice from TikTok.
Right.
But like there's this.
Just keep it to dance moves, right? If you want the latest dance moves, it's a safe place.
Yeah, that's great.
Accounting advice, maybe not. Yeah. Okay.
Yeah, but I think the point I want to make is that, you know, there's this whole push in my industry, the accounting kind of tax advisory industry of like commoditizing your services, right? And I'm all for that to a certain extent, like packaging your services, I would say. Like we do a lot of that. We do a lot of value pricing. We do a lot of fixed rate packages. But with that, there's always nuance. And so I think the thing I want to hit on today is with some of these people advising S Corps, it's always a one size fits all. And if we haven't learned anything listening to this podcast or talking to anybody in my industry, is that there's hardly ever a one size fits all solution in the tax world. Because like, I don't know how often I say this, but it's a lot with clients. They ask me something, I say, well, it depends. This, and this. Right. Like that is so true of S Corps. And so if you're getting pitched on that, like especially, I think a lot of this would go to like kind of younger crowd, like I say younger crowd, millennials. I think I'm a millennial technically. Anyway,
sure.
A lot of people are out there.
You're a millennial if you say you're a millennial.
That's right. Even with gray hair. A lot of people are getting pitched on these S Corps from a package perspective. Like it's an easy cost benefit. Like the package costs this, the savings is this, savings outweigh the cost.
So there's people, presumably social media, that they're just selling, hey, I can form an S Corp, and that's tied into this savings.
Correct.
And it's an all-inclusive, like monthly
right.
deal.
I'll form your S Corp. I'll do the tax return, or just advising you on how to start one. It may not be worth it to you. It doesn't. So let's kind of get into what S Corps are, and then we'll kind of take a look at why you need to probably go slow, talk to somebody.
Buyer beware.
Buyer beware. Yeah, don't just say I'm going to be an S Corp. It's like anything else. It's like I told you earlier. I've gotten these letters in the mail. It's like come to the Holiday Inn for a talk on revocable trust. And I've had clients go to these, and literally they sell you like a 10-step set up your revocable trust. It's like, well, hold on a second. Not all 10 of these make sense to the client, but it's like, no, these are the 10. Yeah. And so that's what I want to convey to everybody is that it's nuanced, and we're going to give you some of the nuances.
Yeah.
All right, so let's get into it.
Okay.
All right, S Corps. We talked about this, I forget what episode, but they're a pass-through entity. And what that means is they're an entity that doesn't pay its own tax. But what happens is, it's always good to give an example. Let's just say you're the sole owner of an S corporation and it makes or profits $100,000. The S Corp doesn't pay tax on $100,000. What did I say? $100? $100,000? $100,000. The S Corp doesn't pay tax on the $100,000. The underlying shareholders do. And since you're the wholly owned or the only shareholder, you would pay tax on that $100,000 on your personal tax return. So that's the first thing to kind of understand is that, okay, it's a flow through or pass through entity. Second thing I would say is in S Corp, the reason why a lot of people pitch it is because it's a way to minimize and or get around the self-employment tax. All right, so let's take a step back a little bit about that. Self-employment tax. If you listen to our last episode, you heard us talk a lot about LLCs. One of the ways an LLC can be taxed is as a sole proprietorship. So you form an LLC. Tyler Warner, would you say Tyler's Tasty Tacos?
Yeah.
Let's keep that going.
Okay.
All right, Tyler's Tasty Tacos, you form an LLC. You don't elect to be taxed as anything differently. You're a sole proprietorship, okay? Sole proprietorships pay a payroll tax or self-employment tax on let's use that $100,000 example again. $100,000 profit, you pay a payroll tax on it, and you pay income tax. So it's like it taxes you like it's a wage. So if you've worked for anybody, you know they take Social Security and Medicare out of your check, they being the employer, and the employer also matches it. Or when you're self-employed, you're paying both of those. It's roughly 15%. Okay, so that's a sole proprietorship. When you form an S corp, you take that.
And that's on the federal level?
Federal level. That's right.
Okay.
It's a federal payroll tax and then a federal income tax. So it's
Right.
2 layers of tax. So if you take that same 100,000, you're a sole proprietorship. You have those 2 levels of tax. Well, if you say, I want to be an S corp, which you can as a single member LLC, you can elect to be taxed as an S corp. I don't want to. Once you that 100,000 in an S corp is not subject to self-employment tax. So right then and there, you should stop and go, well, dang, why would anybody not just do that? Why wouldn't you just take your 100 grand and be like, I'm not going to earn that money as a sole proprietor and pay a $15,000 payroll tax. I'm going to form an S corp and pay none of that. Mm-hmm. Okay, so if you stop there, you think it's kind of too good to be true, right? And it is. Okay, so we stop there. We say, okay, well, what's the catch? Well, the catch is when you form an S corp, and I say form an S corp, when you elect to be taxed as an S corp, the government sends you a nice little letter, IRS, and it says, I forget the language verbatim, but it's to the effect of, let us remind you of the responsibility to pay your owner employees a reasonable wage. All right, so we stop there and say, well, what the heck is that? Mm-hmm. It means if you make 100 grand net profit, and it's customary in your industry to pay whatever job you're doing as the owner, $75,000, that's probably the wage you should be paying. And what that means is now you're back in the payroll tax game, right? That $70,000, that $75,000, you have to withhold Social Security and Medicare on it and match it. So you didn't get out of that 15% tax on that portion. So right then and there, you can see how this could be like wrought with people just coming in and saying, well, don't be a sole proprietor. Just be an S corp. You pay zero, but you've got to take a reasonable wage. And any CPA worth their salt is going to not make you, but strongly advise you.
Right.
Hey, you've got to pay yourself something. Now, there's a game you can play a little bit and say, well, maybe I'll pay a little bit less than market and get over on them a little bit. I think everybody understands that concept, but it's not make 100,000 and pay a zero salary.
Right.
And so that's one of the things too that's kind of going around is that, really pay yourself a low salary, which in our world, we kind of talk about stuff and say that's easy advice. Anybody can give you advice like that, but it's worth nothing, right? Because you got to take a reasonable salary. So let's kind of move the discussion forward. So, okay, I've convinced you now to be like, okay, I got to take a salary.
Right.
So you've already eaten into that perceived savings. Mm-hmm. With a salary comes a W-2 and payroll tax returns, administration. So now we're adding the cost to it. So now it's like I've got to pay somebody, whether that's a payroll provider or a CPA or accounting firm, something, to file quarterly payroll tax returns, to withhold the money, to make the tax deposits timely. You can start to see how you're starting to get some administrative cost and administrative time.
Right.
Then you couple that with the fact that you're an S corp, you have to file a separate tax return. So if you're kind of thinking about sole proprietorship versus S corp, kind of in a column, like you see where you're buying services and they have all the things ticked off of what this one has and this one doesn't.
Right.
Sole proprietorship, very simply, no wages paid to the owner. You can't, so no payroll taxes, assuming you're the only person in the business. No separate tax return. So already administratively, a lot simpler.
Right.
And then let's get to another layer of it. There's this thing called the QBI, Qualified Business Income Deduction. Okay? Let's, again, just kind of contrast that in a sole proprietorship world. So the 100,000 you make it net, you don't pay yourself a salary. You get there's caveats to it, but you get a $20,000 deduction. With the Trump tax cuts that came in a couple years ago, they just said, look, all these pass-through entities, including sole proprietorships, will give you a 20% deduction on your your net income.
So it's kind of like the family standard.
Yeah. So you basically say, that's exactly the way it works when it gets to your personal tax return. They say you made 100 from a pass-through entity, we're going to make you pay tax on 80. It's awesome.
Okay.
Let's bring the example forward. You're an S corp. Let's just say you're an S corp that made 100. And you pay yourself a reasonable salary of $75,000. So now the S corp didn't make 100; it made $25,000. Your QBI is now $5,000. So you've missed a huge deduction, albeit in a world where you don't pay as much payroll tax.
Yeah, and then you had to pay to file 2 returns.
Exactly. So this, I don't know how long we've been doing this podcast, but in 5 minutes, I can give you a clear example of why it depends.
Right.
So, and that's my point. And you're seeing this a ton with people, these cookie cutter, one size fits all solutions, and they just don't. Another thing would be, so let me back up a little bit. If you were to say, I'm going to make $100,000 as a sole proprietor, 10 years ago, I'll say 10, 4 years ago, I might say you might be an S Corp. The cost, the benefit outweigh the cost. Now, with this QBI that's more and the ease of doing everything, I might stay a sole proprietorship, man. Save yourself the trouble. I've told clients that. They're coming to me, they're like, I've heard I should be an S Corp. I'm like, what do you think you're going to make? $80,000? Not now. Not with the new law. But you don't get that level of knowledge when you're watching somebody in a 3-minute TikTok video or YouTube. Right. And I keep going back to TikTok because I'm not even on TikTok, but
yeah, you got to listen to the accountants who are on podcasts.
Exactly. Wait, what? So that's kind of just a quick synopsis of kind of dispelling some of those myths, or just like high level when you get pitched on something, cookie cutter, one size fits all, 7 steps. Although I'm trying to do more of that in my business, it always comes with advisory on the side of it. Right. When it doesn't come with advisory, I think that's when you need to pause and say, like, how could they know my situation that this just fits?
Well, you've got 2 things evolving, right? So it makes it a little more complex because you've got the tax code and the tax law, which is probably not evolving as fast as your business may be, but it's certainly changing. And then on top of that, you've got a changing business, hopefully if you're growing. Right. So I could see how it's not all, any solution is not going to be one that'll last forever, probably.
Right. It's fluid for sure.
How long do you think this QBI stuff is like? How's that work? I mean, it's the tax. It's called Trump's tax cuts or whatever. I mean, we're in a new administration. Is it just like one of those things that could be gone tomorrow? Or?
Well, it was.
How's that work?
Yeah, the Trump tax cuts were done to sunset in 2025. I think by the end of 2025. Okay. So like you brought up the standard deduction a minute ago, like the standard deduction doubled. So the Trump tax cuts, what's called the Tax Cuts and Jobs Act, that's the name for it. Mm-hmm. That was 2018. So the 1/1/18 through 1/1/25, or I think 20. What would that be? 24. That'd be 7 years. So the first of 25. Somebody check me on that, but I think that's right. All those end. So the standard deduction, which doubled, was supposed to revert back to what it should be. Okay. The QBI, which came into play, was supposed to go away. You have corporate tax rates, so like C Corps that were taxed. It used to be like 15 and then 35%. They just went down to a flat 21%. So lots of that all came about in the Tax Cuts and Jobs Act.
Right.
And it's supposed to be done. So it's supposed to have a 7-year kind of reign.
Okay.
Yeah.
All right. So it's not something that could be like totally just yanked away.
Right. And I think, the QBI being the big one. I mean, you can see how, 20% deduction on your net income is huge. Yeah. And there's a whole game to play with that about how much wages. But that's why you need an advisor. But just in a quick example, I can show you how just staying a sole proprietor, you get more of that than if you go S Corp with a big salary. And what have you done? Right. You've created. We didn't even talk about one of the things about S Corps that people don't realize too is that if you have a partner or another shareholder with you, you have to take distributions in direct proportion to your ownership. So if you and I own an S Corp 70-30, if you get $7 out of the company, I get $3. Like not in terms of our salary, but like distribution or dividends. That stumps a lot of people too. It's like, it's not flexible like a partnership. Or a partnership, you can specially allocate things and take distributions, not in direct proportion. Yeah. So it's just like, and that kind of trips people up too.
Yeah, that's helpful practically depending on the agreement you have with your partner.
Absolutely.
And just like, most, like you said, it depends. Most businesses are set up uniquely. I mean, chances are there was a partnership formed because of some special arrangement of like, course. Okay, well, you're going to do this and get compensated this way. And,
Or I'm going to get something off the top. I'm going to get my investment back or something.
I always feel like that's always like, just as it's like, okay, well, here's how we want to set it up. Now, how do we shoehorn it into the right. tax world?
Yeah, you just want somebody coming behind you, knowing kind of what you call the traps for the unwary. Like, look, man, don't do it that way. Do it this way.
Yeah.
That kind of thing.
So who does need an S Corp?
That's a good question. Who needs an S Corp? Okay, I would say people who are profitable. First step, right? You don't need an S Corp if you don't make any money. Why would you go through the trouble? You don't have a profit to be taxed on.
Right.
But I would say when you're starting to get 100, 150,000 of profit, you really need to start considering it. And you think your profits are stable.
Yeah. So it sounds like, and there may be more to it, but if really the only incentive is the gap between your, ultimately the profit you take as an owner and what you can say is a reasonable wage.
Right.
As big, once that grows, that's when you would want to become an S Corp, right? Is there anything else to
you're
it?
Like, that was impressive.
Yeah, dude.
It's almost like you've been listening while you've
I've
been
got another accounting podcast on the side.
Right. Is that the Make It Rain podcast?
Yeah, exactly.
Right.
Yeah. It's just called Loopholes with Tyler.
No, you're exactly right. The S Corp decision is driven by the salary you don't take.
Yeah.
Like, meaning, I have $100,000 profit. How much can I get away with not taking that in the form of a salary? That times the payroll tax I would have paid.
Right.
That's the game.
Yeah.
So you nailed it. Another thing I would say to people, too, to be an S Corp is you got to have equity. Because in an S Corp, you can't take losses that draw your equity down below zero. So let's take it. Okay,
Yeah.
I'll give you a very simple.
That.
I'll give you a very simple example, and this trips people up too. So I don't even think we're going to talk about this, but okay. So let's just say you and I start a business on December 31st. We don't put any money up. We go get a line of credit. Bank says, okay, I'll lend you a line of credit. I'll lend you $100,000, and then we go and say, look, we started a business in construction. So we need some heavy machinery, backhoes and all that. I don't even know what this costs, but let's just say they cost $100,000.
Yeah. Okay.
We go buy $100,000 worth of equipment, which you're probably thinking is, I can write that off. Depreciation, bonus depreciation, right? Well, let's think about our business. We have no equity. Equity being we have no retained earnings or profits that have accumulated. We don't have any capital in the business. You and I didn't put up any money. Mm-hmm. There's no equity in the business, right?
Right.
We go to $100,000, boom, borrow the money, go buy a piece of equipment, $100,000 depreciation. You and I are each going to share in $50,000 of losses this year, right? Wrong. We have no equity. In the S Corp world, you can only take losses to the extent you have equity. I'll contrast that with a partnership. Let's just
so before you get into that, what is is it just nothing? Or?
We don't get it until those losses are suspended out into the future until we have equity. So let's just say that next year
it doesn't create a taxable event though.
No, it doesn't create a taxable event, but I think it creates an event where it's different from your expectation.
Okay.
I've had people do this before and be like, oh yeah, man, we're going to be good this year. We bought a piece of equipment. It's like, well, you don't have any basis. In the S Corp world, equity and with this term called basis are kind of synonymous. They're not the same, but suffice to say,
is the line of where your
basis is basically your tax equity in an S Corp.
Okay.
So in that example, you and I have no basis. We cannot take the $50,000 loss. So if you and I were thinking we're making a great tax move because maybe we have another business where we've killed it, we didn't do anything.
I see.
And that's the problem. It's not that the loss is gone. It's gone this year. It's that our expectation was that we were not going to pay tax on some other money because this was going to shelter it. Does that make sense?
Yeah.
And I see that all the time too.
And the idea is that you can do that normally because it's a pass-through. So
Correct.
ultimately,
that's right.
Like you can have a business that takes a loss and it would offset your personal return.
That's right. Yeah, like let's just say you have a business, but your wife works a W-2 job. So you're thinking, oh man, I'm going to offset some of her earnings this year with these losses from these businesses. They were startups. But if they're S Corps.
Yeah, which that's a whole nother, it's like such a weird world when you're like, it's kind of similar to the myth of like a write-off, where you're like, I'm going to spend money and save money. It's like, well, that's not quite how it works. Like I'm going to lose money in a business to get ahead. It's
I wish this was like what do they call it? A drop in the radio world. Yeah. Like I wish I had the Schitt's Creek. You know what I'm talking about?
No,
oh my God!
Imagine a radio guy though hitting a.
Well, the Seinfeld has the right. Have you seen that one? Right?
Yeah.
The Seinfeld, the Schitt's Creek one's even. It might even be better.
What is it?
He's basically like, yeah, you buy things for your business and the government pays you back. Like, you watch Schitt's Creek?
I've seen a few episodes.
It's the son.
Yeah.
Oh God,
he runs the hotel or whatever.
Yeah. And the dad's like, do you know how it works? He's like,
Yeah.
yeah. You buy things and the government
Right.
pays you back.
Right.
He's like, they have to be business expensive.
Yeah.
Anyway, but you're right. It's like, I forget where we're going with that, but I need that drop, by the
Yeah.
way. I need your help out.
We'll work on that.
Yeah. But anyway, but yes, it ultimately would flow through down to you if it were deductible, but you don't have any basis.
Yeah.
And so, again, you don't lose it. It just goes out into the future. But it's one of those things where if you were planning on it, it's kind of a gut punch. Like, oh, man, I didn't set any money aside for taxes because I knew we started this business. We lost money. Well, you didn't lose money. Like,
Yeah.
well, you lost money, but you can't deduct it.
Yeah.
So I'll give you the other, kind of contrast that with a partnership. If we did that same example, and I'll just revisit it, the same example being you and I formed a business last day of the year, borrow $100,000. We neither one of us put up any money. We go buy a piece of equipment and depreciate it. Depreciate it meaning we take a depreciation deduction. In a partnership, as long as you and I have guaranteed that debt, like which most lenders are going to make you do, then we get the deduction, even though we have no equity.
Yeah.
So it's just a whole different game.
Yeah.
And I always, that's why I say I could probably go on and on and on with the examples of S Corp versus another business, why you got to think about it. This one doesn't often apply, but let's just say it's a really hyper growth business where you're bringing in investors. S Corp, you can only have 100 shareholders. So that's another thing to consider. But the rigidity and the basis, rigidity being if you and I are 70-30, our distributions have to be in proportion to that, the one that trips a lot of people up.
Yeah.
And the basis concept.
Yeah. So it sounds like there's a lot of gotchas for that small, reward potentially.
And maybe not even a reward.
Yeah, exactly. If you're not,
Yeah.
if you're not really stretching that limit. of-
Right. Yep.
Well, last question on S Corps is, what if you've got an S Corp and you're like, oh yeah, I bought in on that whole thing, and you're
Yeah.
not really seeing the benefits? How do you unwind? Do you unwind? Is it worth changing?
Man, that's good. That's a good question. I would say most times it's not worth unwinding. I would think you're still probably doing okay relative to the other options. But if you wanted to unwind it, yeah, you can always go back. You can say, I want to, which I don't, now that I'm thinking about it, I don't think I ever have had a client terminate their S Corp election, but you surely can do that. The problem is, again, if you're an S Corp, anytime you liquidate, it's a taxable event. It's like you sold all the assets, right? Even if you just took them and put them in another company. So I would say if you're an S Corp, continue being one. That's generally the advice I can give you. You probably have saved some. And if you're a growth business or your business has gotten to where it's got steady profits, you certainly are saving money. This discussion is really more for people on the front end, managing their expectations and not getting into something that really wouldn't fit for them until later. Because it might be a situation where you should have just been a sole proprietor for the first 5 years of your business. Would have been a lot easier. Yeah. And then elected S Corp. So that's kind of where I'm going with this conversation. But to answer your question, if you are one already, it's probably helping you and probably saving you, and you should just stick with it.
Gotcha. All right. Well, hopefully that gives you some good advice on the pros, cons, kind of what to watch out for.
Yeah.
Especially accountants on TikTok. Just a wild bunch, I imagine.
As you say it out loud, I'm just
Yeah.
like, oh man, there's another kind of meme video. That video, you've ever seen it where the guy says, he makes up this song about, I'm an actor trying to get a job, but I just tell people I'm an accountant because nobody questions you when you say you're an accountant. We'll watch it in a minute.
Yeah. Okay. All right. Well, yeah, that's it for today. If you want some more information on S Corps and what you should do, get some time in with Marcus. He'll answer your questions, and because it depends, right?
It always does.
All right. So go to Mire.group. You can find more resources there, as well as get in touch with the Mire Group at Mire.group. Have a good one.
See you next time.